Hi, this is Casey Boland with HCM Wealth Advisors and CPAs. I'm joined today by Doug Johnson, who's our Senior Investment Strategist, and Dan Rinck, who's our main investment research analyst here at HCM. So, welcome. We wanted to talk. Certainly, there's been a little action that's been going on in the markets relative to what's been occurring in the global world here of geopolitics. And that's always something that when that occurs, we want to have some discussion and dialogue around, guys. So it's you're seeing on the chart here, there's been many geopolitical events that have occurred over time. In fact, there have been 32 of them as we date back to World War II. One that really, I think, sticks in many people's minds is going back a couple years with the Russia-Ukraine crisis, which is still ongoing. And when that occurred, we saw a market drop of close to 10%, but it happened in a very short period of time. But the rebound happened in a very short period of time as well. So that's very common with geopolitical events. You can have a substantial amount of volatility in a short period of time, but you don't want to necessarily react to those events. But we have to be cognizant of what's going on in the current economic environment. So the timing of what's occurring recently with the Israel and Iran attacks that started back on June 13th, we're at a time where, if you look at, we're dealing with more heightened national security concerns. Stock valuations are not inexpensive at this point in time. We've had a nice rebound in the market. It seems like the consumer and business sentiment has really come around, but those have been fragile. So when you have a market event like have occurred here in recent weeks, there can be concern that certainly can really weigh on the markets and potentially weigh from an economic standpoint as well. It's too still early to tell, but part of this chart is more to also give you a perspective of when you look out further in time. In the far right-hand column, a lot of small numbers that are difficult to see, but looking out 12 months after events have bottomed, the majority of the time, the market has rebounded and rebounded at double digits. So these events oftentimes are short-lived, and but oftentimes they can be very volatile. But we'll see how this one is played out. So far, it's been pretty benign. The concern, though, is more of what happens suddenly when the U.S. became involved in this situation. So, over the weekend, we shared stories around the office. You heard word on Sunday that the U.S. became involved in this scuffle, and I think a lot of concern was we're going to see a lot of volatility potentially on the downside to come into this week. And just like with Russia-Ukraine, you saw oil prices really spiked over $120 a share, and you would expect that oil prices would potentially spike as well. And after Monday, you got a 1% spike in the S&P, stock surged, and you had a big drop off in oil prices. Now, to be fair, oil had surged back for a short period of time, a handful of days, going back from June 13th. It had gone up from the upper 60s up to $75 a barrel, but in short order, oil has dropped from 75 now to below $65 a barrel. Quite the opposite, I think, that everybody was expecting to probably see. So, and it's continued even today. So the market has continued to go up another 1%. We're recording this on Tuesday, June 24th. So we've seen 2 days in a row of a strong market. And at this point in time, we're at, we think, a ceasefire. We'll see if that continues to hold. But at this point in time, that appears where we are at this juncture. How will markets react as time goes on? And what are some of the risks that are still out there? Certainly, probably one of the biggest risks that I think that people are on people's minds is what if they were to go ahead and Doug, go ahead to the next slide. What if, or maybe I already missed the slide, if they were to go ahead and shut down the Strait of Hormuz, and if that occurred, certainly you could see a substantial increase in oil prices. It wouldn't have as much of an impact on the U.S. As the U.S. does not get as much of their oil from that area of the world that's heading west. Most of the Strait of Hormuz has to do with oil that's passing, going east and going to Asia. So it could have a little bit more of an impact on China and some other countries there. So certainly that could be one of the risks that we may be dealing with. I think when you look at the far extreme risk, some people have expressed that, are we looking at the possibility of a World War III type of scenario where Russia or China gets involved? And we would put that at a very, very low probability that that would occur. I think a lot of countries, while China depends on oil from Iran, I don't know that they're going to put that much weight in trying to protect Iran and take that type of measures. And we would expect that probably would be the same result with Russia as well. Other potential scenarios, certainly this may continue to escalate. And does the U.S. continue to step in more? We don't know. But at this point in time, we appear that we have a little bit of a ceasefire for the temporary moment. The operation that came out on Sunday night that many of you may be aware about, it's called Midnight Hammer. It involved targeted strikes on 3 nuclear facilities in Iran. So the idea was to try to take out these facilities and hopefully reduce their ability to use some of this nuclear material that they have. So they struck Fordow, Natanz, and Isfahan, and we'll have to see if it was enough damage. Some people have claimed that Iran may have moved and protected some of that before some of the damage, but U.S. seems to be countering that they don't see any movement. I think a lot of thought, guys, was that this would be protected, and I think Fordow is considered to be 300 feet under the ground and be protected. But some of those missiles certainly may have done substantial damage, and we'll know likely a little bit more in the coming weeks, maybe what that looked like. I don't know if we'll get the full answer on where the results stand, but we'll see what that brings in the coming weeks of this conflict and also with the market. But in the short term, I think we're all a bit surprised that at this point in time, the market is pretty much surged on this news, and oil has gone down quite a bit. Doug, Dan, what's next in this chapter?
Well, I mean, Doug sent out a message Sunday night to us saying like, okay, we gotta really be watching the news wire, and we were even talking about getting out one of these webinars Monday morning, and well, the reaction was not quite what we expected. Yeah, so from a price perspective, that's kind of what I want to dig into today. You're not really seeing much action. It's been pretty quiet. It's just been a slow and steady grind up. So if you hadn't turned on the news whatsoever, you wouldn't have any idea that any of this was happening if you were just looking at stock prices across the board. This chart right here shows multiple asset classes since just after Liberation Day. So early mid-April, we're looking at here the S&P 500, which are those candlestick bars, the red and green. We're looking at small caps, we're looking at large cap growth, we're looking at large cap value, we're looking at international stocks, and we're looking at emerging market stocks. If you look at this chart kind of across the board, you're not really seeing any asset class that's standing out above the rest. It's kind of a buy everything rally. I think after Liberation Day, a lot of people started moving money back into the equity side, and they were pretty much buying assets across the board, getting reallocated. The S&P 500 there, since the Liberation Day, is up about 14%. The leader out of Liberation Day has been large cap growth. You've really seen it rebound as it was the hardest hit leading up to it. Second behind large cap growth is actually emerging markets. So you're seeing investors start looking outside of the US. Emerging markets is up almost 20%. And then, we have small caps, which has actually performed very well since the bottom as well. The big laggard here, I say big, it's returned 11.5% compared to the S&P 500's 14, is large cap value. So it's really, very telling with what this market action has been like recently. Investors have had a big appetite for risk. They're plowing into these risk names. And when we see that, you're really seeing the price action show that investors really want the risk. They're seeing less risk on the horizon. They want to load up on the asset classes are going to give you the biggest return. Um, so earlier in the year, we talked about kind of a narrow leadership in the market, how the Mag 7 was really the only thing driving the market performance. Um, that's a very different story than it is right now. This chart right here shows the percentage of stocks over the 50-day moving average. So how many stocks in the S&P 500 are over their 50-day moving average? We often cite the 50-day moving average as kind of a medium to long-term moving average, and then the 200-day moving average as a very long-term moving average. So the 50-day moving average kind of tells the next 3 to 6 months out. You have 70% of stocks in the S&P 500 over their 50-day moving average. I typically look for 61% of S&P 500 stocks as a sign that the market is very healthy. We're at 70. This is as of close yesterday, so even after today's market action, we're up 120 basis points, so 1.2% right now. That number's probably going to be higher. So breadth so far, we've had some breadth thrusts earlier in the rally, in the recovery. Breadth so far is looking pretty strong. Um, so if we go and dial in specifically on the S&P 500 and what the price action has shown, we are almost at all-time highs. We're 0.8% below an all-time high. We've basically taken out every single significant level. We've retraced almost the whole entire drawdown move. Um, so again, 80 basis points away. If we look at other asset classes though, XLK, which is the S&P 500 technology sector, has already made all-time highs. If you look at other asset classes, emerging markets, small caps are even breaking out of very strong bases. You're seeing that a lot of these sectors, asset classes are breaking out of all-time highs and continuing to go. Now, when we see a big index like the S&P 500 approach their all-time highs, it's not out of the question for it to stall out a little bit. So as the market kind of digests all this information, again, we're 0.8% away from all-time highs. It might stall out a little bit. That doesn't mean it's going to drop, but there's going to be a little bit of price discovery there before potentially taking off. And if we see, looking across the board, all the people with the risk appetite for technology, for emerging markets, you're seeing the ARK ETF, Kathy Wood's super high tech, high growth ETF getting a lot of big bids. So investors have a high appetite for risk right now, and are really following through. So in probably this week, next week, we're going to see S&P 500 kind of bounce around those all-time high levels. If I'm looking at evidence with the rest of the market, I would see that there's a very good chance that the S&P breaks out of those new all-time high levels and continues going up. Again, that's purely price action. We still have tariffs on the table. We still have, this war is not completely in our rear view mirror yet. But if you were to strip all that out and just look at the price, I would think that you're going to be looking at all-time highs and continued strength in equities for the next 3 to 6 months.
I thought everyone had forgot about tariffs at this point,
Yeah,
with
exactly.
all the other news. But sure enough, we have not forgot about tariffs, and obviously, the beginning of April, that was the main headline that caused all the volatility in the market. And we got a set of, we'll call them 90-day reprieves or pauses on certain ones. And I think it's important to focus mainly on the agreement with China. I think that's the elephant in the room that's going to dictate a lot of what we're seeing here. But this is just a chart that kind of shows the timeline history of the tariff rate with China right now. We don't have to go through all of this, but what I think is important is you see this 90-day pause on most goods, the level drops back down, but a date to watch for in the future, because if no deal is reached prior, the current pause that we're seeing will end on August 12th. So that's still, it's not a long ways away, but it's also not next week. But I think as we approach that date, we could see the return of some volatility if we don't have a deal reached prior to that. Because not only that, you get that, starting to intersect with that late summer, historically, we'll call it, more volatile times than others during the year. So that is one date that's kind of circled on our calendar for sure, is that August 12th date, to see if we can come to some type of agreement with China before that on tariffs, and hopefully put that in the rearview mirror. Now, switching gears just a little bit here, we've gone over a lot of the Iranian situation and the current market situation. I want to touch on something that we've implemented on a tactical basis in our portfolios, kind of inside the fixed income portion of our models, and it's something that we really haven't owned before, or if we have, it's been quite a while since it's been in the portfolio. So you may have noticed it, and I wanted to spend some time touching on what exactly those positions were, and really giving a rationale on why they're in there and kind of what we're looking for adding those in. So we're going to call that kind of our hard asset basket, so to speak. So there's three main positions that we've added to allocations, and the percentage is not large by any means, but it's still enough that we think can accomplish our goal of trying to be somewhat tactical on this view. So the first asset in this would be gold. Obviously, gold's had a really nice run over the past year, 2 years. It's actually kept pace with the S&P 500, even outperforming it a little bit, I believe. But as we kind of took a look at the current situation and what we're trying to express here, we felt like gold was an appropriate asset for this basket. Then you've got a broad commodity basket. So in the commodity space, you've got two main indices that kind of rule. You have one through Goldman Sachs, which is more energy heavy. And then you have one through, I believe it's Bloomberg now, that's more diversified. So the ETF that we're using tracks the Bloomberg index, just because we wanted a little bit more diversified exposure to that commodity basket. And then the last asset in here would be the Swiss franc. We're not buying Swiss francs directly. We're actually getting that exposure through an ETF product, but it does give us direct exposure to the Swiss franc US dollar exchange rate. So as we look at these three assets, what do we think we're gaining out of here? So I think these individually and as a group have historically provided some good protection against, I'd say, two situations. One would be kind of an inflationary environment, one that we saw in 2022, and one that I think has, some people concerned going forward. And then I think there's also some elements of, risk off. And this certainly with the Swiss franc, if we were entering some type of deflationary environment, I'm not sure that these assets are ones we would continue to hold, but we're not necessarily, of the belief that that's where we're headed. So kind of what was the rationale for adding these to the portfolio? So really, it's just the culmination of all the fiscal concerns that we've seen building, I'd say, over the last 20 to 25 years, finally coming to a head. People have asked me in the past, are you concerned about the U.S. debt situation? And I'd kind of always answer the question the same. Yes, I am concerned about it. Am I concerned about it right now? No. Will it be a problem in the future? Probably. But we don't know when that point is. It feels like over the last few months, this has become more front and center. for a few different reasons. So obviously you've got high current debt and deficit levels, and we'll touch on that here visually in just a second. You have the recent Moody's downgrade of U.S. Treasuries, which personally I think in itself is not a big deal. But I think what is important is it's another kind of spotlight on this issue. And I think at the time it kind of thrust it back into investors' viewpoints here, saying, okay, here's a rating agency recognizing that this is an issue. As an investor, should I now be more concerned about that? The Fed has been reluctant to cut rates, and I think they've cited inflation concerns. Now, Chairman Powell spoke today, and he made some comments along the lines that they probably would have already cut rates if not for the tariffs. Whether that's true or not, I can't really speak on that. But what I can say is that the rate cutting forecast has been pushed back several times, and every time that it has been, there's been concern about inflation around it. So the Fed's looking at this and they're saying, hey, we'd like to cut rates, but we're really concerned that these tariffs are going to cause inflation down the road, and we're being cautious on that. And then lastly, the proposed tax bill that we've seen right now is projected to increase the deficit by 2.8 trillion over the next 10 years. I've seen some projections that number is actually higher. And I think there was hope that this wouldn't be the case. The new administration came in and they were very much adamant that they were going to look to be a little bit more fiscally responsible in lowering debt levels, lowering deficit levels. And then this bill comes out and you kind of look at it and you say, all right, were you serious? Were you not serious? I think there's also some issues with the kind of the extent that the DOGE program was able to cut spending. I think preliminary numbers looked really good, but then when it actually came to a vote, it seemed like there wasn't a whole lot that was being stripped out there. So you've got kind of the culmination of all of those things right now coming together, and looking at longer term treasury rates, the concern about, okay, can we see an environment where we go back to longer end treasury yields being much higher than they are right now, because investors are going to demand a higher rate of return to take on the kind of excess risk that we're seeing right now. As I mentioned, the debt level stands right now at $31.5 trillion. If you look at that line, it's not vertical, but it's pretty close. So when the debt levels are this high and when rates are this high, interest costs spike exponentially as well. Now, this isn't on this chart, but you can see there's no real periods here where this line is really getting any lower. And I think at some point it will become a problem. And before you say, hey, it's the Republicans, it's the Democrats, it doesn't matter. Here's a chart. Here's the same chart, just denoting who was the president at the time. So red is Republican, blue is Democrat. The bottom line is they both sides love to spend money. And I think that, in order to really tackle this problem, there would probably need to be some really hard decisions made, ones that would likely slow growth significantly and possibly put us into recession. So it's easy to talk about doing these things, but then when we actually have to put them into action, it seems like it's a little bit more difficult. So lastly, we look at what treasury rates have done recently and where they've come from. So obviously in 2020, during COVID, when everything was shut down, it wasn't abnormal to see rates drop to extremely low levels. I mean, you had the 10-year below 1%, and the 30-year not far behind it. But since then, we've seen kind of a steady rise in longer term yields. Now, with this recent Iranian situation, surprisingly, you've seen yields kind of pull back a little bit, but the 10 years stayed in this 425 to 450 range, and the 30 years kind of stayed in this 475 to 5% range. If these concerns about debt and deficit levels continue to gain steam, and we start to actually see inflation ramping back up, it's not crazy to think that you could see a 30-year at 5.5 or 6%, or a 10-year bond at 5 or 5.5. And historically, when 10-year bond yields have gone over 5%, that's given equities some headaches. And you can see, back in 2000, 1990, rates were much higher than they are even today. So we've come a long way from kind of that zero interest rate policy that we saw after the great financial crisis. But in adding this hard asset basket, we just want to ensure that if long-term rates do move significantly higher, we have some type of asset in the portfolio that can try to counteract that. This certainly isn't a call that's saying treasuries are going to, collapse and default and become uninvestable, and that there's this huge risk to that. That's not what we're expressing here. It's simply the fact that we feel like the risks have combined to a point now where it's prudent for us to put something in there to try to counteract that. And again, this is a tactical view. I mean, if we got into a situation where inflation falls off a cliff and we see deflation or a recessionary environment, we would likely take that out because commodities wouldn't perform well in that environment. And historically, gold has not been a good risk-off asset. The Swiss franc has been, but as a basket, I don't know that would be a worthy asset to have in portfolios. And then another kind of move we made was to kind of take our core bond exposure to almost 100% corporates with our defined maturity products. We just felt like the corporate landscape is in much better shape maybe than the US. Now, again, if you own an individual treasury bond, we're not saying it's going to default. So please don't hear that. But we feel like the risk return right now is much better for us in the corporate space. So if you see those new positions in portfolios, that's kind of the why around that. And if you have further questions, please feel free to reach out to your advisor, and we're happy to walk through that with you. But Casey, I think that's all that we've got for this update. So if you want to take us out.
Again, thank you for joining us, and please don't hesitate to reach out if you have any questions or you'd like to discuss any of these topics we've covered in this webinar with your appropriate advisor or Doug or Dan. We'd be glad to help, and we'll look forward to seeing you all soon. Thank you.